All right. Welcome everyone to week 3 of Simplifying Securities. My name is Lindsay Taylor, and I'm really excited to be with you for the third week of this 5-week training series. For those of you who don't know me, I have been with Primerica for almost 15 years now, and my job is me and my team we are responsible for securities licensing and securities training. So that my awesome teammates and we are trying to help you grow your securities license business. And then once your teammates are securities licensed, get them trained and confident so they can go out there and help more people get financially fit and saving for their future. So as I said, we are on week 3 of this training series. So the first 2 weeks, we talked about account types and product types and really built the foundation and a lot of the knowledge. And so now we're going to move on and talk about sales tools. So you've got the knowledge, and now, all right, you're meeting with the clients, and what do we do next? If it's not already asked out there, we have recorded everything. It took a little while to get everything through media advisory and legal and reviewing everything. I can't thank them enough for getting all of that work, but we are about to put all of the recordings and all the PowerPoint decks out on POL as well as any of the questions that we asked. My team's done a fantastic job going and making sure we have answers to all of those extra questions that maybe we weren't able to get to during the training. And so that you can refer back to the recording, you'll have the slides as well, and you'll have the frequently asked questions or the Q&A behind it. Speaking of slides, this is probably my favorite week because I have 17 slides total, and half of these are like the agenda. So we are full on demos, love talking about the sales tools. But before we do sales tools, we want to do a quick reminder on what is dollar cost averaging, the investment profile questionnaire, and the Morningstar model. So knowing your clients before we dive in and show you not just how to use the tools and how to run a hypo, but when would you use Investment View Plus versus Morningstar's tools, Hypothetical Illustrator, and Portfolio Solutions. So dollar cost averaging. Before we talk about systematic investing, averaging. An average, whether, I don't know, my kids do new math right now, and we haven't gotten to averages, so I'm sure they do it differently, but they lovingly like to say, I do 1983 math. So 1983 math of an average is you're trying to find the cost of several different things. Or so if I buy 5 things at the grocery store, and to find the average cost of those 5 things, I add up all 5 things and then divide it by the number of things. So let's say they were $1 each or $2 each. So $10 divided by the number of things, which would be 5, meaning the average cost was $2. Super, super simple and easy. So how does that apply to investing? Well, if you're talking about the grocery store and buying things, the cost of eggs today, cost of eggs goes up, right? They are up, and I think it's like $7. So we're having breakfast for dinner tomorrow night, and breakfast for dinner is now like you're having fancy dinner tonight because the cost of eggs went up. Do you know anybody out there that is like, you know what? Yes, I need to buy eggs. I need to buy all the eggs. No, they don't. But you know what? We do that with the stock market. When you were sitting there wondering, like, where she's talking about eggs. How is she going to bring this back? Here's how I bring it back. So when the stock market goes up, everyone says, yep, I'm all in. I want to buy all the eggs, all the shares. I'm all in. But we don't do that with anything else in our lives. But the stock market, we want in when it goes up. But when it goes down and things are on sale, people run away from that. Can you imagine? We just went through kind of all of the holiday sales. When people say, hey, this is on sale, you're like, yeah, no, I'd rather wait till it goes and is twice as expensive. No, we don't do that for anything because it's the different emotion in investing in the market. But having a systematic investment in place takes away all of that emotion to where, yes, some months you may buy eggs at $7, but some months you may buy eggs at $2. And over time, they're going to average out. So let's stop talking about my weird grocery store analogies and bring this back to the investments. And let's take a look at 2 different investors. So investor A, investor B in those 2 different markets and how a systematic investment strategy works for them. So systematic investing is just a regular investment. So if you have a PAC where they're putting in $100 a month every month, that's a systematic investment plan. So both investor A and investor B have $100 a month, and the share price for that first month is $10. So investor A, market keeps going up. They love you. The second month, you're invited to the Super Bowl party. Month 3, you get invited to St. Patrick's Day, Easter. I mean, they are every month, they are just so excited. Their account value is growing. Investor B has a different experience. So investor B, the price is going down. And they're like, I can't invite them to the Super Bowl party. By month 3, you are not getting invited to St. Patrick's Day, no corned beef for you. And like by the next month, that they don't want to call, they don't want to talk to you. But month 5 and 6, you go back up and it's $10 per share, and they've calmed down a little bit. But let's look under the hood and see what their experience actually was. So investor A, if you look here, that price per share went up every single month. But how many shares did they purchase? They actually purchased less shares every single time because it was more expensive, just like the cost of eggs analogy. So when eggs are more expensive, well, if you only have $10 to purchase eggs or shares or whatever it is, well, you're going to buy less shares because it costs more expensive. So investor A, their account value at the end of that period, they accumulated 42 shares, which is great. But investor B, because that market went down, and let's see that 4th month where they were like completely not happy with you, it was on sale for $2 a share, and they were able to buy 50 shares, which is more than investor A purchased the entire 6 months there. And so at the end of the period, they were able to buy 126 shares. And if you're in that accumulation stage we talked about last week, it is all about buying shares. You want to hoard shares, as many shares as you can purchase. That is your goal, to accumulate wealth. And if you have a systematic investment plan, you can take out the emotion of all of the ups and downs and just, all right, every month, whether it's going up and you have investor A's experience or investor B's experience, you know what, I'm going to buy them every month, because over time, I'm going to lower that average of the cost per share. So you can see, remember we went all the way back in the beginning and talking about an average. So investor A's average shares, invested $600, they accumulated 42 shares. So 600 divided by 42, their average cost per share is $14.19. Investor B, that remember went $10 all the way down to 2, back up to 10. With the same $600, they were able to buy almost 126 shares. And so their average cost was $4.76. So what that means is if investor A sold all of their shares at $14.19, they would break even. But investor B, same, they put in that same $600, they only have to sell kind of that whole book for just over that average sale cost to make money. And so that's where that average comes in, and that systematic investing, so you can take advantage of those downturns and those sales in the market without getting all caught up in your head. So I want to talk about that, because in a minute, we're going to show you how you can do that and show that example in the sales tools. You might have a client that says, okay, that's great, but that's a hypothetical example. Show me how this actually works. So we're going to show you that when I go into investment view by Refinitiv. But before you know which type of fund that you want to offer or talk to the client about, you have to get to know your client, and that's through the investment profile questionnaire. So the investment profile questionnaire has 3 questions. So it's, what is the goal for your investment? When do you plan to take the money out? And what level of risk can you accept? So that first one is, and the answer to each question sorry about that. Each question has 3 possible answers, and it doesn't matter what their answer is. This isn't like going to the dentist where they're saying like, how often do you floss? And you kind of smile and say, I floss twice a day, even though everybody knows you probably didn't. They can tell it's uncomfortable. What this is, it doesn't matter what answer they want, it's what is the actual client's answer. Because if you match this, then you're going to be able to match the client profile and match them to a better fund or portfolio. If you just go through and pick, they're not going to be matched well. They're going to be in a investment that they're not comfortable with, and then they're going to be calling, and it's going to create a not happy fun time. So let's go through each of those different investment questions. So what is the goal for your investment? Is it growth? So you're in that accumulation phase, so you just want it to ride. Is it income, meaning I have a chunk of money and I just want to earn some income off of it? Or is it somewhere in the middle, growth and income? And the next one is, when do you plan to take money out of that account? Do you need it like now, within 3 years? Do you need it? Are you accumulating money? So I don't need this for over 7 years, or is it somewhere in the middle? And then the last question is probably the hardest for clients to really understand, is what level of risk can you accept? So it's how comfortable are you with the loss of principal over time? So what that, I think when we use the term risk in the industry, I still today, every time I hear the word risk, I think of like adrenaline junkie behavior of skydiving, diving with sharks, like all of that kind of stuff. But that's not what it is. It's the ups and downs in the market. How comfortable are you watching the investment go up or down? Like I said, not a trick question. It's whatever the client is comfortable with. And when you start talking about those ups and downs and, you know, possibly losing money, if they're giving you the look of like, not at all, well, they're probably low and not comfortable, and that's totally okay. If they don't need the money for a long period of time and they're like, yep, nope, I understand there are ups and downs, and sometimes I can be down, sometimes I'm going to be up, I'm good, then they have a high risk tolerance, highly comfortable. So it's answering those 3 questions, but really talking to the client and making sure that they understand what you're asking so that you can best match their client risk profile. All right, so let's say I'm a growth, I don't need the money for a while, and I'm somewhat comfortable. I'm not really comfortable with the high ups and downs. If you follow the chart here, growth, more than 7 years, the medium, we give it to you. We say, all right, this person is a growth model portfolio, no guessing, this is what they are. This is their growth objective. So what do you do with that information after that? Well, you are going to use these guidelines. So it took this right from the beginning of the SB 70. So these are the client model portfolios. So if you've an investor that's an aggressive growth investor, well, they should be in mutual funds that are entirely stocks or equities, because they can handle the ups and downs. And we talked about last week, even within the mutual funds, we have mutual funds that fit every spectrum of whether they're aggressive growth or they're income investors. So this is really saying, all right, if, yeah, like we said, aggressive growth, 100% stocks, or if you're over here on this far side and you're on the income, it's kind of more 70% those bonds, those fixed income, those more conservative funds, and then 30% stocks. These are general-ish guidelines, but depending on how your client answers the investment profile questionnaire, these are the type of portfolios that you should be building for your client. And if they only have enough money for one fund, we have funds that fit, you know, a one fund solution for any of these client profiles. Now, that being said, if you do have a client that says, hey, you know, they come to you, let's say they've got 20 grand or, you know, 5 grand, whatever it is, they have a chunk of money that they saved up, you ask them the investment profile questionnaire, they're moderate growth. Like, all right, what next? Well, we've contracted with Morningstar to create model portfolios. So these are preset mutual fund portfolios. So these are not managed investments. These are mutual funds. And we work with Morningstar Investment Management, and they create these models. So what they do is they take those 5 risk profiles that we just showed you, and then our 5 platform fund companies, and we say, all right, here's the SB 70, go build a model portfolio for each type of client for each fund company. So they go, there's a whole research process. They annually get on the phone with the investment companies and really dig in and build out these models. They update it annually, and they put out 2 models for each fund company. So there's a plus version and a premium version. Only difference is the plus version has 3 to 5 funds and the premium has 5 to 8 funds. So if you've got a client that has a little bit more money, then use a Morningstar model. These are pre-built into the Morningstar sales tools as well as into Turbo apps. So if you go and you build, you're going through Turbo apps that we're going to walk through next week, you can profile the client and say, you know what, I want to work with Nuveen and this is an aggressive growth client, we're going to pick the aggressive growth plus model, and it's going to pre-populate that information completely for you. I'll show you where the pages on POL when we switch to the demo portion in just a second. But Jason, were there any Q&A questions or anything that I covered too fast between now before I move on to the demos?
Yeah, there was. We're getting a lot of questions on where you can actually find the questionnaire. So what I would do personally, if you go up to the top right of the just regular POL homepage, the search bar, and put in investment, profile questionnaire, it'll be the first thing that pops up in the search. So you can go there, it'll list those 3 questions and then the breakouts of the 5 profiles below.
You can also pull up any paper application, and the investment profile questionnaire as well as the models here are all in every paper application as well that you can pull up. All right.
And then another question, this is a great question, is when are these models updated? Is it annually, semi-annually, every other day?
Yep. So they are updated annually. However, your client is not updated. And if I picked a model in 2018 and I invested that, my model doesn't change every year because that's kind of more managed investment strategy. Whereas the Morningstar models, we update them every year. Typically, I think they're somewhere at the end of the first quarter. They're going through the update process now. And yeah, somewhere March or April is when they're updated. Great question.
Then, yeah, the last one here, and I think this is a good one, is dollar cost averaging. Is that something you have to do when you open the account, or can you add it on later to the account?
Yep, systematic investment, you can add that on later. It is just adding a PAC to the account. So we do systematic investing on the investment side through PACs. You can set them up per fund, you can set it up monthly, quarterly, however you want to set up that, or not however the client wants to set up their systematic investment. Great question.
And there is one last one. I know you'll probably cover this in just a moment, but I want to get it out there. It's a great question. What's the difference between plus and premium in the portfolios, the Morningstar profile portfolio?
Perfect. Easy is premium version has more funds. So you can get a little bit more granular into the different asset classes because they have more funds to pick from. But really, both of them are good. Both of them have a lot of the overlapping funds. It's just premium has more funds. That's all.
That's it for now.
Okay, so we are going to pull up. Let me pull up. All right, POL here, and we're going to dive into those sales tools. And so the first thing I want to show you is, first of all, where those Morningstar models are. So if I go over here, if I go over here to products and then investments, and I scroll on the left-hand side, scroll all the way down to sales tools. Down here, right above Canada, is the Morningstar model portfolios. So you can click on here and it's going to show you, it's got a great PDF that has all of the different funds that are in all the portfolios in there. The informative credibility pages kind of walks through their process. I went over that really, really fast, but they'll dive in and say, here's how we pick these funds. Here's the analytics that we go behind. They're great ways to go in and, whichever fund company that you want to use, you can dive in and look on the Morningstar portfolios. All right, so Refinitiv is the company that runs Investment View Plus. It is a great tool. Any of these tools that you use, it does not matter to me if you go and say, yeah, I don't like Investment View, I want to use Hypo instead, or I like Investment View Plus. It doesn't matter to me. I just want to show you kind of how to run a hypothetical illustration in each of these and kind of where I like to use. All right, this is where I like to use Investment View Plus, and I think this tool really shines in this example, where I like to use Hypothetical Illustrator or Portfolio Solutions. Again, whatever you're comfortable with, you don't have to use any of these. You don't have to, you can use all three. Just want to show you all three different samples out there. So Investment View Plus is your tool that you're going to run hypotheticals to. So you're going to show growth over time or dollar cost averaging, and want to start and just show you how to run a basic hypothetical. And my blanket statement before everything is I'm going to try to use funds from all different fund companies. This is not a solicitation for any one fund. Use the funds that you want to use. These are just, I'm trying to pick a random funds in there, and yeah, whatever legal has asked me to say about these different funds. So to start with Investment View Plus, you are going to search for a fund. You can search by name, or if you know the ticker symbol, you can put it in. I am going to go and start typing in Franklin Income and then click search. So the search results here is going to bring up every share class that Franklin has of that fund. But like we talked about last week, at PFS Investments, we sell A shares. So we're going to click on Franklin Income A, and it's going to move that into the middle bucket because these are the selected securities that we're going to run for that hypothetical. If we want to add more in there, then just search for another fund and go back through that same process. For this one, we are just going to use one fund, and to run the report, just click on this first report. Simple, that's all you do. All right, so what it does is it automatically runs a $10,000 investment from when the fund opened, which is in 1948. And it kind of runs and is going to say, hey, here's what happened there, and all the way through January 2023. You can see if you're a numbers person, we have lots of numbers on this side, and then we have the graph on the other side. Now, I don't know about you, 1948 was a long, long time ago. Was not around then. So let's change this report to something a little bit more relevant and saying, hey, let's say something started, at least 10 or 20 years ago. So anytime you want to make a change to the report, then you click on this gear icon right here, and this is going to be your settings. So I'm going to click on settings right here, and this brings up all of your options, and this is how you make changes to the report. So it starts out in the initial investment here, it's $10,000. We're going to keep that the same, but we're going to change the period. We don't want this since inception. And let's just go back 20 years, because 20 years, digestible time period, the internet was around, 20 years is a good time period. And all I have to do is click apply, and you can see that time period changes to 2003, that $10,000 investment. One of the other reports that you can run that Investment View has awesome is, remember on that right-hand side, you had all the different reports. You can click here and change to any one of those different reports. A lot of these are super, very industry. They're great if you get into a very analytical client. If you pull up the high-low report and you're like, I have no idea what this is, don't use this report. That's all you need to know. If you can't explain this report, you can't explain it to the client, don't use it. So we are going to go back to the hypothetical report, and I do want to switch to the profiles. So this is great because you can look at any of these funds and kind of dive in underneath the covers and say, all right, what is in that fund? We talked about this a lot last week, and all of the different funds and their holdings. And they also, on Investment View Plus, they'll give you the Lipper ratings for the different funds. So you can see their ratings. 5 is the best, 1 is the lowest. You can see the ratings for the fund, you can see their holdings in there and the returns as well. So this is a great profile. As you're starting to learn about the different funds and the funds that you like, you can go through and you really use the profile report to see the insides of the funds. All right, we're going to go back to the hypothetical and the $10,000. That is how to run the basic, but I promised you on how you're going to tell a story with Investment View Plus. So we are going to go back and talk about dollar cost averaging, and that client that's like, yeah, that's great, but that's a fake example in a brochure. Show me a real life example of dollar cost averaging. You can absolutely do this with this tool. Mainly because if you look here, they have shares here. So we are going to look at somebody putting in $100 a month and the shares that they purchase. So we are going to go back up to that gear and click here, and we are going to change that initial investment amount to just $100 a month. And we're going to change the period since inception to that 20-year period because it's a more digestible time period. And actually, you know what? Let's even just change it to 10 years. And then, excuse me, we are going to go down here and click on investment strategies. So here's where, if you want to show and add that pre-authorized checking, or if you want to show a withdrawal, or we call it a SWIP, so systematic withdrawal plan, click here on the type and either say investment or withdrawal. We're going to do dollar cost averaging because we're accumulating money right now. So we're going to say, I want to invest $100 a month, every month, starting when we said 10 years ago through this year. Now, one of the things that you can do, and we'll show you next week in the applications, is put on a PAC Plus. PAC Pluses are awesome because they are saying, look, you may not have 500 some dollars a month to max out your IRA right now, but let's get you started, and we'll start at $100 a month this year. And every year we're going to increase it by $10 or 10% or whatever you want it to be. So every January, you are going to pay yourself first and give yourself a little bit of a raise and invest more money into your account to save for your future. It's a great way to get your clients on the path to save more. Like I said, it's called a PAC Plus. You can do it when you first set up the account or later on. And so that's what this increased by, if you want to show how that money can grow over time. We're going to keep it simple. We're going to invest $100 a month, and do not click apply. If you click apply, it doesn't apply it. What you have to do is click on this check mark here. If you call me or Jason or Jeanette afterwards and say, hey, my investment strategy didn't come on, it didn't work, it's because you probably didn't click the button right here. Yeah, you probably still do this 10% of the time. It's okay. Make sure you click on the arrow, and then you can see, all right, my investment strategy, you see it's kind of printed on the page. It's going to be included into the hypothetical. I'm going to now click apply. It's going to tell me the fund minimums below the minimum, which is fine. And you can see for that 10-year period, we're going to invest $1,200 per year, so $100 a month. And then we're going to see what the market value does. So it's growing, but we really want to look at the shares. Now, looking on an annual basis is really, really hard to see. So we're going to go up here and change this frequency from annual to monthly. So you can sit down and tell your client, all right, we're going to invest this $100 a month. So you can look at the investment column, the sales charge. This is, so out of that every $100, $4 is that sales charge. And then, the market, we're going to look at your market value, the percentage change, so that's, did you make money or did you lose money? How many shares you got? And then the NAV here, that is the price per share. So this is every month, this is what you bought the shares of this particular fund at. So you can see the first month, all right, I put in $100 minus the $4, $96, and I bought 42 shares. And over time, you can see the market value, for the most part, for a while, it's going up because it's all positive. So let's you know what? Yeah, let's see. Let's fast forward to 2015. 2015 had some struggle years. It was down a little bit. So 2015, I put in $100, account grew to $3,135, and I have 1,369 shares. Well, the next month I put in $100, but the account went down to 3,107. And then the next month it went down to 3,089, even though I put in $200 into it. And that's because the market was down. However, we're not showing the client that. We're showing, hey, you're accumulating money right now. So that systematic investment plan, that investor B, if you look over here to the share column, it doesn't matter where you look, you are accumulating shares. So even when you're going down, that share balance keeps going up, even though the market value is going to fluctuate. And when you're in that accumulation stage of your life, you want to grow your shares. So I think being able to show, yes, this is a great tool for hypotheticals, but being able to show that dollar cost averaging strategy with actual funds, and it really doesn't matter which fund you use because you're going to accumulate more shares, as long as it's a systematic investment plan. But I think this is really where this tool shines and shows out, is those systematic investments and showing those shares. Before we switch over to the Morningstar tools, Jason, were there any questions on Investment View Plus or Refinitiv that I sped over or didn't show?
Yeah, we're getting a lot of new people asking about the broker information. So guys, you're the broker. It's your information. It's your name. It's your title. Are you an RVP? Are you a senior regional leader? It's your office information. It's your cell phone number. It's your phone number. One thing to note though, you're not affiliated. So on the right-hand side, it will ask affiliated information. Don't put anything in there. You're not affiliated with a bank. Okay, so make sure you keep that clear. Everything else is your info. Now, again, you can go, there you go. Lindsay pulled it up. This is perfect. So we're not affiliated. So we're not affiliated. It's your info. So when you get promoted to RVP, SVP, Senior National Sales Director, you can always go back and update that info anytime you need to. Another great question is, and I know we went through it fast, is how do we get to Investment View Plus again through POL?
Yep, so perfect. So if you go to products and investments, and if you scroll all the way down on the left-hand side and you click on Refinitiv right here, that's how you get to Investment View Plus. So the name of the tool is Investment View Plus, but the company is Refinitiv. They actually changed their name again, so it's not Refinitiv. But if you click on Refinitiv here, that's how you're going to get over to Investment View Plus. Great questions. Any other ones, Jason, or?
Yeah, last one is someone, I saw several of these, it's really a two-part question. Can you have multiple funds, and then can you change the amount from $10,000?
Yep, absolutely. So if you're having multiple funds, I'm going to go back to the home page here. So the little house, you go home. All you have to do here, so I have Franklin Income here as my selected security. If I want to add Franklin or Templeton Developing Markets, I can either from a recent search here, or I can type it, let's see. If I spell the companies right, that typically helps. So I can go through, typing today is not my friend. So I can go through and search whichever fund, it's probably too big, I want, and add as many funds to this section. And then when I go back over to reports, it's going to pull in multiple of those funds. So right now it's just saying I'm Franklin Income A, and I can go to the view of Templeton Markets, and you're saying, well, wait, but those are two separate ones. If I click on that gear and I change from my scenario from being a single fund, I can compare two different funds, or I can say I want these as a portfolio together. So that is super simple. If you click on the gear, that's where you can change all of those funds. And if you want to change the $10,000, again, click on the gear and your initial investment amount. You can change this amount to whatever you want it to be. You just change it and then click apply it down at the bottom. All right, in the interest of time, we are going to move on to the Morningstar tools, but I do want to bring up really quick. So you can call my team for any of these, or not call, but you can email us and we can set up a training and walk through how to do any of these tools, walk through in your scenario. Happy to, that's what we're here for. But Refinitiv also has kind of for that advanced training, if it's you've got one person, you've got multiple people. Kendall Miller on their team just works for training, and they work with different brokers, so they can set up regular office hours, or hey, I want to do this, I have this client, help me. You can go and contact Kendall at kendall.miller@lseg.com, and they can help for that kind of advanced training as well. But feel free to use either of those for training on these sales tools. Or, oh, I didn't add it in. I was going to say, you can also contact any of our investment partners. All of the sales tools use, or all the sales desks use either kind of Morningstar or Investment View Plus or something similar. And they are all completely trained on how to run hypotheticals, how to talk about them. So if you have a client that's really technical that wants to dive into this, they can absolutely help you out beforehand in getting confident on all of these numbers. But If you don't have a client that's technical and you sit down and you talk to them and they say, yep, I want to invest, again, don't go through these reports. Don't sell past the close. Only use these if you need to use them. And they're there for you. Use them all day long if you need to, but only use these for clients that, okay, hey, can you show me the performance of the fund, or you want to show a real life example of that dollar cost averaging scenario. You know, I can't stress that enough, because there are a lot of numbers on here. There's a lot of charts, and you don't want to put yourself in a situation where they're sitting there going, okay, but yeah, but what is this? What is this column? What is this? And you kind of start stumbling, and just don't show the information if you don't need to. Okay, so if you go back to the investments page, products, investments, and right below Refinitiv is Morningstar. So we're going to click on Morningstar here. And we have two tools here, Portfolio Solutions and Hypothetical Illustrator. So Hypothetical Illustrator is going to be very similar and comparable to the Investment View Plus. We're going to walk through and how to show the scenarios and kind of when I like using Hypothetical Illustrator. And then Portfolio Solutions is a comparison tool. So that tool is really great once somebody has money and you can say, all right, here's what you have. Here's kind of what we're talking about, our new recommendation, and why they're different, and assuming why yours is better. So we're going to start back with the hypothetical and show you how to run that basic hypothetical, and then how to tell a really good story using Hypothetical Illustrator. So we're going to go over to Morningstar site, and remember those Morningstar models that we talked about? These are all preloaded because, again, Morningstar helps create these. And so if you have a client that's, you know, a conservative growth, and it's, let's say that they don't have, you know, $5,000 to maybe $10,000, their growth plus, just double click here and it automatically pulls in the mutual funds that are in that portfolio, and actually the allocations as well on the next page. Try to make it as easy as possible if you do want to use those Morningstar models. Let's say you don't want to use them, and we're just going to click new scenario here. And so this is the basis of this tool. So it's kind of walks you through across. You're going to add the investments, then you're going to say how much you're going to purchase them. And then if you're just running a straight hypothetical, you can run the reports, or I'm going to show you really how to do, you know, the really cool thing that I'll just keep building up for a minute in just a minute. So mutual funds, you can search by name. If you know the ticker, just type it into the box here and it'll pull up. And once it pulls up, just click on it and it moves to the investment box here. You can search. So if you were going to say, I promised I would use several different ones. So let's say American Century Income. Rather than waiting for that search box, I can always hit search here and it'll pull in all of those different results for me. And all I do is if I click on it and click add, it'll add it down below. If I've gone, oops, I clicked too fast and I don't want that one, simply just click remove, and anything that stays in there is going to be built into your hypothetical. So we're going to use Invesco's equity and income for this example. And now that we've selected our funds, we're going to move on to buy. So we're going to click buy here. So it starts with a $10,000 sample, but this tool always starts with a trailing 10 years. So they don't go back to the inception date, but starts with trailing 10 years. Now, anything in blue, it's a little bit hard to see between the blue and kind of here, but here you can see I can't click on anything to change it, but anything that's in blue, I can check and change to customize to the scenario that I want to use. So here, trailing 10 years, you can see I can change it out to kind of one of the presets, or I can click custom down here and change it to whatever scenario I want. If you have multiple funds in there, you can use this top bar that says apply to all, and it applies to all the funds. So if you have multiple funds in there and you want to change the time period, use that top apply to all feature. So we're going to keep $10,000 trailing 10. Really, at this point, you can hit generate report, and it's going to generate a chart. Now, everything is going to have the same chart. It's just going to be kind of what data is in there. So always the red is going to be your portfolio value. So it's starting where you started and kind of where it grows to. And then the like weird greenish yellow line, that's going to be your net amount, investment amount. So that's that $10,000 you put in, and then the portfolio value. The blue line is your benchmark. In this case, the S&P 500, it's against that. You can change that in the report settings field. We just ran this real quick to kind of show you, here's the basis, here's how to run the hypothetical. And you can see you have a chart here. It talks about the assumptions made and the performance. So you put in $10,000, it grew to $20,000, you had a 7% rate of return. And down below, it'll go through every single year, similar to Refinitiv on that screen that we had of your beginning of balance, what you put in, any money that you took out, anything you reinvested, so any of those dividends and capital gains that you reinvested, and then the final market value and your return on this side. Every report you run is going to look like this. It's just going to be, what's underneath it. So really cool scenario that I said that you can do. So you can show dollar cost averaging with this tool. Cancel. But you can also show if someone has saved, and let's say they saved up $250,000, and maybe we've spent a lot of time talking about that accumulation stage, but you've got somebody that's, maybe 50, 55, you're like, hey, you've accumulated this money, if you can hold on to it for, maybe 10 years or so, let's talk about a distribution plan and how much money you would need when you move into that final phase and what you need for retirement. So I'm just picking a fund. I'm not making a recommendation for this fund or any of the other funds. Use the funds that you want. These are just my random funds. All right, so I'm going to come over here to buy, and I am actually going to say 0. I don't want to start with any, or no, I do want to start with money. I'm sorry. We are starting off with $250,000, and my strategy that we just talked about of holding for 10 years, and then I want to pay out for 20 years in retirement. So we are going to look back 30 years. 10 years holding, 20 years retirement, 10 plus 20 is 30. So I'm going to change this trailing 10 to custom. And 30 years ago was 1992. I don't know about you, but 30 years ago to me is still 1980. Apparently that's not the case, which is apparently probably why new math works better than my old 1980s, still 30 years ago math. But anyway, so $250,000 over for a 30-year period, so 92 to 2022. What we're going to do next is walk over here to the advanced buy sell tab right here. So we are going to change here where it says invest. We're going to click on it and click down and change it from invest to custom. So if you're clicking on this and you're saying, but Lindsay, I don't have custom, it's because you're clicking up here. So if you click up here on the apply to all, you don't have the custom link, but if you click down here, you get custom. So I'm going to click custom here, and here's where you can add if you want that investment strategy. So I can say invest $100 a month, and if I want to do that PAC plus, that annual upward adjustment, I put that information in there and click update grid. So that's going to show me my dollar cost averaging. But we are going to do that systematic withdrawal plan of, all right, we held the money for 10 years, and then your client's like, you know what? I need $3,000 a month to live on. I think that's probably a good amount, maybe. So we're going to say, all right, we're going to hold it for, again, the 10 years, and then we're going to withdraw $3,000 a month beginning in 2002 going to 2022. And then we click update grid. So you can see all these zeros came in, and these zeros, it may be hard to see, but these are all in blue. So you can click and edit them however you see fit. So again, holding for 10 years, and then you can see every single month they're taking out $3,000 a month. You can go through and change this if they're like, you know what, every July I go on a vacation and need $4,000. You can go through and change this to be as crazy custom as you want, but we're going to stick with our $3,000 strategy for right now. And then we're going to click OK. And I'm going to come over here and click generate report. All right, it takes just a minute. All right, we are going to go through. I'm doing that. I know I blew the screen up really big, but I'm doing this on purpose. Is here we go. All right, so we have this chart, right? So the green line is your net amount invested. So we invested $250,000, and then we started withdrawing money out, right? So we withdrew $470,000. That's more than we put in, right? So we're going to go and see the super awesome thing that you can do with Hypothetical Illustrator. So we put in $250,000, and you said, all right, I've worked hard for this money, set and let it grow. And we didn't touch it for 10 years, and it allowed it to grow. It had some ups and downs in the market, didn't touch it, and then started taking out $3,600 every year. So it's showing you that distribution, that $3,600. And if you go to the end of the 20 years, well, we've taken money out systematically. And at the end of that 20 years, you still, that same $250,000 has now still also grown to $1.6 million. Again, not a solicitation for this particular fund. Go run funds. This type of strategy kind of, I've ran this with all kinds of different funds, but it's something to go and show if you have that systematic investment plan. So we're going to go back to that, taking the emotion out. If you're doing crazy things like in 2008 when the market's down and you pull and yank all of that money out, well, you are probably not going to have those same results because the market's going to be down. So you're going to sell low and kind of mess it up. But if you have a systematic, all right, I want this money, I'm going to set aside, I'm going to be disciplined about it. I don't have anybody's faces on here, can't see anybody else, but I think this is a pretty good use of that tool and that strategy on there to show how you can save. And you can go through and change this to 40 years and invest on the front end, hold it, and then that distribution phase on there. So again, you got missed the screen. Jason, before I queue you up for questions, want to show everyone again, that's on the advanced buy sell tab, and going to custom is how you go through and showing that initial purchase, holding money, and then selling or putting a systematic withdrawal strategy together on the back end. Jason, any kind of questions or comments kind of during?
Yeah, so a lot of questions. I sort of got stuck there for a second. Can you leave these for both tools, Investment View Plus, the hypothetical morning stars? Can you leave these with clients?
Mm-hmm. Yep. These are approved. Make sure that when you go through, you don't have to. If I go, hold on, let me go to this tab here. If I go to the report options page, there are a whole bunch of different reports that I'm not going to go through. And if you don't know how to talk about a distribution and withdrawal summary, and if you don't need to, don't run this report. But there are plenty of ones that you can pick. I don't need any of these reports. Just run, that main hypothetical. The one you can't unclick is the disclosure materials. So we have all of these disclosure materials. As long as you're providing that entire packet with the client, you can absolutely leave this with the client. Mm-hmm.
Okay, another one, and I think this is a great question too, to really help us with other providers is it just for platform accounts, or does it include all platforms or other companies completely?
Yeah, you can go through this universe. If you go on the investments tab and you click select universe, you can pull up any mutual fund. They do have stocks in there as well, even though that we are not approved to sell them at PFS Investments. But in case you have a client that does have a stock portfolio and you're trying to say, all right, here's what you have and here's what I'm recommending, you can put in the variable annuity sub accounts in there as well. You can see all of these different funds here is how you can, are the funds that you can use. So the mutual fund universe is open to any mutual fund in the US, even ones that we don't offer. Great question.
So I've got a two-parter, and they sort of two parts, but I'm going to put it in two parts. A lot of people are asking, is the Primerica fee, aka sales charge, included in these funds? And, we've got a lot of big time field leaders on this call as well. And a great one of ours, one of our favorites, not going to name names. But she does ask, does it bring up breakpoints and ROAs? Does it include that information? So
Yep.
if you could give us both of those.
I can. So it does. And it definitely allows you to be super transparent with your clients. Because let's say that $250,000 here on this invest line, all right, new investment, $250,000 that you're going to put in, and that upfront sales charge is that $6,875. So these are all attached to, whether you, regardless of the tool you're using, they have data feeds from all of these providers that they pull in all of the funds, the breakpoints, and the sales charges in there. And so, yeah, it's all pre-built in. You don't have to do anything. You just pick the fund and it's going to do all of that for you. Great questions. Okay, so we've got 9 minutes left and want to show you the very last tool. So we talked about if you're accumulating money in strategies. No, I want to leave. I've just hit the right button if I want to leave. All right, so we talked about strategies if you're in that accumulation phase. We talked about showing somebody that, hey, maybe they're in that kind of middle phase and, all right, let's hold it. Don't take money out, and then kind of the distribution phase. Well, what if you're in somebody that either has money and you're wanting to say, here's why you should invest with me, and here's why this portfolio is better, or maybe they were in an aggressive fund up front and they're moving into that middle protection phase. And so you're like, hey, we did the investment profile questionnaire, met with you again, some things have changed, and the aggressive growth fund we initially picked is no longer appropriate for you because you can't tolerate those ups and downs in the market. But so I want to show you this new fund approach. Again, if they say, sure, I trust you, whatever, don't do this. But if they want to see a fund, you can use portfolio solutions, and showing that comparison is really where this tool shines. So we are from that Morningstar page, we are going to go to portfolio solutions. And here you're going to enter in the current portfolio here. Or if you don't have any funds, you can skip it and just put in a dollar amount. But being super, super candid, if you're just going to run that straight hypo, I would use one of the other tools instead if you're just putting in cash on that side. So let's say they were in an aggressive growth fund. So we're going to use ClearBridge aggressive growth. Again, not selling one or the other, just picking random funds. And let's say they have $214,000 saved up. They've saved up and they're in that. All right, I want to kind of transition over. You can see here, we've got, you pick their investment profile. So you were aggressive growth. Now you're a moderate growth. And it's going to give you that asset allocation that we talked about very in the beginning and saying, hey, you remember you were 100% stocks because you were aggressive growth. You said you can't handle the ups and downs. We're getting a little bit closer to retirement. Let's add some bond exposure, that wonderful orange color here. And let's get you a portfolio that's a little bit closer. Now, all of those Morningstar portfolios we talked about are all pre-built into this tool as well. So you can go down and say, all right, we were in Franklin. We're going to continue using Franklin. And let's go to the plus model. It's going to pull in the Franklin Plus moderate growth portfolio in here. And it's going to automatically put out the percentages to make it match that portfolio. So you can see it comes here. I can change. If I want to change it, I just click on a fund. And I would say if you are putting in, it is a little slow if you have to sit and actually type the fund. So I highly recommend you always use the ticker symbol. But if you know the ticker symbol, it comes up real quick and you can click on the name and then add the funds that you want as well. Super simple, easy to use. If you make a mistake and don't need one, click clear. And then I am going to click create PDF right there. So you've put in pre, new, you can go through and change all the report settings that we talked about. But all you need to do is when you're at that point is hit create PDF and it's going to generate that report for you. Okay. So this report, it's going to have a lot of information on there because I had all the pre-settings, but one of them is going to talk about your target asset allocation. So, hey, remember we're moving, you're a little bit more conservative. So we're moving out of that US stocks and into something a little bit, more conservative. And the portfolio comparison report, which is here. So this report is going to be your best friend for comparing the two because it's saying, here's what you have. And here's the new version. Let me scroll up. So I don't have time today to go into what the Morningstar style box is and the sector weightings and all of those things. We'll save that for more advanced training. You can always call one in the sales desk and they can talk about their funds and the style boxes. If you can't explain these, don't get into that conversation with the client, because that'll just end up looking bad for everybody. But what you can do is talk about the asset class mixes. So you know what, you were aggressive growth, and so all in stocks. And so now we're going to diversify you a little bit and get you that bond exposure because you're moving down, you're getting older. We want to be a little bit more conservative. So talk about the change in the asset allocation and then look at the returns will show you that more conservative as well. So on that aggressive growth fund, 1 year is down 25%. But if you look at the 10 years, 7%, and the since inception, 10%. Not bad, because remember, again, you were accumulating, you had a really long time to handle any of those ups and downs in the market, and that longer return, that's where you wanted because you were more aggressive. As you're becoming more moderate in there, let's look here. And yeah, the 10-year and the since inception, it is lower because it's a more conservative portfolio. And so maybe not that accumulation. But if you look at the 3-month to even the 5-year, the returns on this side are significantly better than the aggressive growth because it's a different portfolio. Yes, we can go into, well, this funds and all that, but looking just at that asset class, this is something that you can talk to the clients and saying, hey, you just told me that you can't handle that negative 25% down. Totally get it. You're in your 50s, not as good. Let's put you into something more conservative. And even though the 1-year number is down, having that diversification and diversifying your assets between those different asset classes is going to help you in the long run, and you're going to be in a much more appropriate risk tolerance class. Okay, so Jason, I have 2 minutes left. Was there kind of a big question or anything kind of?
Yep, and last one is, why would you use one over the other? And that I'm regarding the hypo tools.
Perfect. All right, so as I answer that, I do want to bring up, when I have the additional training resources on the page while I'm talking about this, using one versus the other, guys, use comfortable with. Whatever you feel most comfortable that you can go and, hey, I know how to use this tool. First of all, use that tool. Use the reports that I can explain that I am confident at. Use those reports. Whatever you are most comfortable with, use. I like Refinitiv, one if I'm running a hypo, and I like Refinitiv to show those shares and those dollar cost averaging. I really think that that's a really strong selling point of that tool. If you have a client that they mentioned Lipper ratings, that's a great way to use that because the Lipper ratings are included in Refinitiv. The hypothetical illustrator, to me, I mean, I've been using that same tool for all 15 years. I know it like the back of my hand. I can sit and run kind of whatever hypo real quick on there. So I like running that as any of my hypothetical tools. That graph, it's a fantastic graph. Everybody likes graphs. But hypothetical illustrator will let me show that, okay, I can buy for some years and then sell as a different strategy. So I really like being able to use that with hypothetical illustrator. And then portfolio solutions, I only use if I have a comparison. So if I'm saying, here's what you have and here's why this other part is better, that's why I use portfolio solutions. So I have our contact information up there. If we missed anything, if you want extra training, that was a lot of demos and they were really quick. And I just wanted to give you guys enough to get you guys, all right, I know a little bit. Feel free to contact us and happy to walk you through how to run a more advanced one or anything else. And then of course, again, call your strategic partners. They can run the hypos for you. They all have access to something, a hypothetical tool, either one of those or something very similar, and they can help run and walk you through those as well. We all have great partners. Thank you guys for being on, running over a little bit late this week. Next week, we are going to go through, and it is another demo heavy week. Oh, I didn't put the last one in there, but next week we are going through the application. So we're going to show you guys how to use EasyKey. IRA assembler, and then we're going to talk about the turbo apps and kind of show you a sneak peek of SAM 2.0, which is coming soon. So guys, thank you guys again for your time. We appreciate you every week. Thank you, Jason and Jeanette, for being my awesome panelists this week. And we'll see you guys later. Thanks.